Hello, welcome back to Gold Off the Charts. In this financial market full of twists, games, and fog, we don't just look at the surface excitement, we dig into the real deep patterns. Every day, we bring you a bit of deep financial insight to help you see a little further, walk a little steadier, and live a little longer on your journey to growing your wealth. In today's video, I know many of you have been waiting a long time, and the past couple of days might have been really stressful. We have to take a deep look at the past weekend and at today's Monday opening. At what happened in the precious metals market, especially gold and silver, a massive sell-off that will go down in history. This is absolutely not fear-mongering. If you've been watching the market these past 2 days, or if you had positions in gold or silver, your feelings right now are probably very mixed. We witnessed history, but the cost of this history was extremely severe. Let's first review the scene of the event. Gold, which was originally surging with unstoppable momentum, climbed all the way to a historic high of $5,600, and then, in just 2 days, yes, just 2 days, the price fell like a kite with a broken string, dropping straight from $5,600 to around $4,700. Guys, that's almost a $1,000 drop! Just on last Friday alone, the single-day drop was over 9%. What does that mean? For gold, which usually has relatively stable volatility as a safe haven asset, this kind of drop is like a nuclear blast. And at Monday's opening today, panic still seemed to be ongoing, with the drop reaching 5% at one point, continuing the largest decline in over a decade. This kind of movement instantly brought many people who were used to gold always goes up back to reality. And if you think gold has been bad enough, then take a look at silver. Its performance can only be described as catastrophic. Spot silver, from the exciting high of $121.48 per ounce last Thursday, went into freefall, plunging nearly 40%. As I record this video, silver is still falling, down to around $74. I know you're sitting in front of the screen full of questions. What exactly happened? Why did the bullish setup suddenly change overnight? Is the bull market over? Should I cut losses and exit? Don't worry, today's video is here to break all of this down for you. We will start from the most direct news triggers and dig all the way into the underlying macroeconomic logic and even the reconstruction of the dollar system. I believe after watching this video, you will have a completely different understanding of this crash. We need to figure out who actually pulled the trigger. What does this crash mean? And more importantly, is the $5,600 gold price a temporary top? First, let's talk about the two most direct triggers behind the dramatic turn in precious metals these past 2 days. This was a perfect storm, the result of multiple factors stacking up. The first reason, and the core shock, came from the United States. Trump finally announced his nominee for the Federal Reserve chair. As soon as this news came out, it hit the main logic that had been supporting precious metals recently, the currency devaluation trade. You have to understand, the market is very sensitive. People were buying gold, betting that the dollar would weaken, and that the Fed would print money without limit. But when the new nominee was announced, expectations instantly changed. Investors started worrying that the new chair might take different policies, possibly even like Volcker back in the day, taking tough action to defend the dollar's credibility. So, many profit-taking positions chose to sell at recent highs, regardless of cost. This directly made January 2026 the most volatile month in precious metals history. Suki Cooper, the global head of commodities research at Standard Chartered, put it simply, she believes the market was due for a pullback anyway, because prices had risen too much. But what triggered this panic selling was a combination of the Fed chair nomination and broader macro capital flows. Looking at the dollar rebound, or expectations for real yields, these factors all point in one direction. It's time to sell and pocket your profits. Look, the dollar index has already started a big rebound from the 4-year low it touched earlier last week. When the dollar strengthens, gold priced in dollars becomes more expensive for overseas buyers, and buying naturally slows. Even the most optimistic gold bulls have to admit, the previous rise was too crazy, the market positions too crowded, and leverage too high. What's happening now is basically a deleveraging process. The second reason comes from a sudden cooling in geopolitical tensions. Another pillar supporting gold prices was the Middle East situation. But over the past 2 days, tensions in the Middle East suddenly eased, which directly hit safe haven buying and pushed gold and silver toward the edge of a cliff. In terms of news, President Trump confirmed that Iran is negotiating with the United States. Trump hopes Iran agrees to give up its nuclear program, and Iran has signaled willingness to talk, warning that a larger conflict would harm everyone. On Saturday, Trump made it clear in an interview on Air Force One that the U.S. is seriously talking with Iran. He hopes to reach an agreement both sides can accept. He even revealed that while the U.S. has a huge fleet heading toward Iran, it's meant to strengthen their negotiating position. Iran's stance has also softened. Iranian President Raisi said a larger conflict would hurt both Iran and the U.S., and diplomacy is always the priority. With this statement, market fears of World War III instantly faded by more than half. Since there's no war and talks are happening, the gold previously bought for safety, does it need to be sold? This is the market's real reaction. So combining these 2 points, the Fed's new variable and easing geopolitical tensions, gold and silver lost their upward momentum in the short term and faced massive selling pressure. But guys, I want to remind everyone, this crash, although severe, if you look at it on a longer timeline, it actually just wiped out all the gains since January 20th. Think back to January 20th. At that time, Trump announced plans to take over Greenland and impose tariffs on Europe, which scared the market and sent safe haven funds rushing in. That extra premium has now been squeezed out. But this does not change the overall upward trend of gold. Next, we get to the core part of today's video. The most in-depth analysis. For this, I referred to very authoritative institutional opinions to help everyone cut through the fog and see the future clearly. The previous $5,600 high in gold, in terms of price level, was not surprising. What was surprising was how fast it reached that target. What concerns people more now is that gold surged past $5,600 and then fell back. What does this mean? Is this a temporary top for gold? My conclusion first, no. On the contrary, this could be the start of a historic change. Why? Here's an interesting data point. When gold reached $5,500, the total value of all gold in the world was about $38.2 trillion, while total U.S. debt was $38.5 trillion. This is a historic moment. This means that since the collapse of the Bretton Woods system, gold's scale has for the first time stood equal to U.S. debt. This shows that the global credit system based on U.S. debt has serious cracks. Even though gold has now fallen back, suggesting $5,500 is a psychological barrier, the answer depends on one thing. Can the U.S. rebuild trust in its debt? You could say that the deeper driver of this gold rise is the distrust in the U.S., specifically during Trump's era, which triggered partial substitution for dollar credit, what we call de-dollarization. This is the ultimate value of gold. It's easy to see that in the past year or two, many geopolitical and policy risks actually came from the U.S. itself, making the dollar, which should be a safe haven, ineffective. A simple comparison. During the second half of the Biden administration, gold rose less than during Trump's second term, despite also facing various problems. Besides distrust in the U.S., whether U.S. debt is still safe is a real question. In other words, if a new president comes in, could this trend reverse? When I say not safe anymore, I don't mean default is happening, but that returns are dropping and credit quality is marginally weakening. First, debt repayment constraints are becoming rigid. Although U.S. debt won't default. The interest coverage, that is, interest payments divided by fiscal revenue, has been rising steadily since 2021, reaching a historic high of 18.5%. This is above the 15% warning line set by agencies like S&P and Moody's. Higher interest payments mean that, to keep debt sustainable, the U.S. has less fiscal flexibility. In other words, the quality of debt that can actually be repaid is declining. Second, the holding structure is internalizing. Foreign holdings of U.S. debt have fallen from 34% in 2014 to 25%. This shift from a global reserve asset to ordinary sovereign debt means that the extra demand for U.S. debt has weakened. Lastly, relative value is shrinking. The ratio of gold's nominal value to U.S. debt keeps rising, showing that investors' marginal preference for dollar sovereign assets is falling, and they are turning to physical gold for ultimate value preservation. Simply put, from a fundamental perspective, high interest rates, high debt payments, and high leverage also make U.S. debt worrisome. Distrust in the U.S. and issues with U.S. debt itself together prompted partial substitution for dollar credit, which is de-dollarization, and this is the core driver of gold's rise. But so far, de-dollarization is still a clear binary split. Why do I say that? Because we notice that some monetary authorities are selling U.S. debt to buy gold, mostly in Asia and emerging countries, while other monetary authorities continue buying U.S. debt, even reaching new highs like the UK, Japan, and Belgium. This has formed two clearly divided camps. Looking at gold price gains by region, you can also see this. Since 2025, gains during Asian trading hours were much higher than in Europe or America. And since the start of 2026, the strong gold rise mainly came from Asia. This shows that de-dollarization has not become a global consensus. More accurately, it's two clearly separate groups doing different things. After all, for most countries still inside the dollar system, there's no need to de-dollarize, and leaving the system doesn't give a better option. But for the other group, facing sanctions and the weaponization of dollar reserves, de-dollarization is both unavoidable and necessary. So, increasing gold reserves becomes almost inevitable. But the issue now is that since Trump's second term in 2025, global tariffs, especially on allies, challenging the existing international order, combined with gold surpassing U.S. debt at this critical threshold, could blur the lines of this previously clearly divided camp. Could more of the market that was in the U.S. debt camp start shifting to gold? Once gold rises past the total U.S. debt, what changes could happen? Will more central banks in the middle ground start thinking about diversifying their anchors and adding gold to their reserves? In this sense, de-dollarization won't happen quickly, nor does it need to happen immediately, but confidence is gradually eroded, and sometimes just having this doubt is enough. Of course, we also need to look at this process rationally. In the foreseeable future, the dollar and U.S. debt are unlikely to be completely replaced. Undeniably, the dollar's reserve currency status remains strong. What's more likely is a partial loosening of the dollar system, moving from single dominance toward diversification. The dollar has no real substitute. Gold is valuable, but it doesn't generate income. When dollar credit is damaged, gold can act as a safe haven and store of value asset, but it cannot replace a credit currency in providing interest rate liquidity or pricing assets. Also, due to limited physical supply, gold cannot support the massive global trade settlement. Additionally, the de-dollarization process can be repetitive and even reversed, and the old order will not give up easily. Possible variables include a new U.S. president re-engaging with globalization or allies to regain trust, U.S. economy finding new growth drivers, the U.S. enforcing fiscal discipline, and the Fed controlling financial expansion, reshaping trust in U.S. debt through short-term pain. Even administrative measures targeting gold, like regulation, selling gold, or taxes. So what problem is the U.S. facing now? The pick two of three dilemma of low inflation, low interest rates, and dollar dominance. For the U.S. government and the Fed, the current reality is wanting low inflation, low interest rates to reduce debt costs, and to maintain dollar dominance all at the same time. Back then, Volcker raised rates sharply, sacrificing the second goal, low rates. But unlike then, although inflation is far lower now, given much larger debt and interest payment pressure, raising rates sharply to anchor inflation and restore trust in U.S. debt is not easy. An ideal scenario for the U.S. and the Fed would be a sudden new factor solves inflation, like AI dramatically boosting productivity, leading to deflation in wages and goods. Then, the Fed could lower short-term rates while shrinking its balance sheet to apply financial restraint, slightly raising long-term rates to make U.S. debt attractive and trustworthy. But in reality, challenges remain. How big will AI efficiency gains be? Won't shrinking the balance sheet affect liquidity and cause market turbulence? Won't shrinking the balance sheet increase U.S. debt financing costs? If rates drop too much, could inflation expectations reignite? If the Fed faces the choice of protecting debt or the currency, the exchange rate is undoubtedly the cheaper option. Accepting slightly higher inflation and small dollar depreciation can ease debt pressure, paying off expensive debt with cheaper money in the future, but at the cost of long-term trust in U.S. debt. In the end, gold benefits. So, back to our initial question. Can we now say this is the end of the gold trend? I don't think so. To truly end this trend, the U.S. would need to spend heavily to solve the pick two of three dilemma of low inflation, low rates, and dollar dominance, and rebuild trust in U.S. debt and even the U.S. itself. But how much could they do? Honestly, we can't give a final answer. But one thing is certain, Gold has now entered a new territory unseen for decades, and the old way of things will not let itself be replaced easily. So, the January 2026 gold crash, though shocking, could be a deep squat in the middle of a bull market. Short-term drops are painful, but may pave the way for sustainable growth. Looking at historical trends over the past few years, every major rally has been followed by sharp corrections and sideways consolidation. This time, the drop is relatively larger. Still, the pattern holds, and the bullish outlook remains. Overall, the core support of this gold bull market is intact. Expectations for Fed rate cuts within the year still exist. Although geopolitical tensions have eased, history over the past decade tells us that easing is temporary. Also, central banks' long-term trend of increasing gold reserves remains unchanged. After proper consolidation, gold still has plenty of room to rise within the year. But in the short term, we have to admit bears still have some advantage. Until the price stabilizes above the 5-day moving average, expect volatile, sideways adjustments. If you want to enter at this stage, my personal view is to watch for support at the 30-day or 60-day moving averages, then consider buying on dips and positioning. So, just like we need to view rises rationally, we also need to view declines rationally. Don't panic, wait for the market to stabilize during corrections. Facing this historic volatility, how do you feel now? Do you think the bull market is over and plan to exit, or are you sharpening your tools to buy the dip? What's your view on the $5,600 level? Share your thoughts in the comments, tell me your perspective, and also your plans for the future. Finally, I must emphasize again, the content today is purely my personal observation and analysis and is not any investment advice. Financial markets are unpredictable. When making trading decisions, you must consider your own risk preferences and think and decide independently. If you found this video helpful, please like, subscribe, and share so more can see it. That's all from Gold Off the Charts. I'll see you in the next video.